Sea Limited dropped a grand total of not 10, not 20, but nearly 30 whopping percent when they recently reported their 2023 Q2 results on the 15th of August. So this 30% post-earnings volatility came on the back of SE stock price already suffering an 85% drawdown from their peak. So after this carnage, they're down by more than 90% from their peak of $372 per share in October of 2021. So is Sea Limited really under the sea? Let's find out. So the initial growth story of Sea Limited was predicated on the three-headed dragon analogy, with three strong engines of growth that had a huge runway: e-commerce, gaming, and digital finance. So they were starting out their footprint in the Southeast Asia region, and it was a great growth story. So many in the region were either underserved or underpenetrated. So why did Sea Limited stock drop so badly? So there were primarily three key reasons. First, their gaming business was decimated. Many believe that a picture speaks 1,000 words. So let's run this interesting experiment. Based on the two infographics that were extracted from Sea's earnings presentation back in 2021, what does this tell you about their gaming business? So they look good, right? Heck, it was phenomenal. Many companies would kill to have such growth and profitability. So let's take a look at 2 years later. So this is Sea's gaming division's latest result. So I do have 3 words to describe this development. Under the sea, pun intended. Jokes aside, you can see that Garena has suffered greatly from losses in bookings, quarterly active users, and by translation, quarterly paying users. So their bookings fell by 66% due to two main reasons. First, Garena has always been extremely reliant on their core offer, which is the gaming title League of Legends. But Riot Games, who happens to be the owner of League of Legends, has recently decided to self-publish the title in Southeast Asia from Jan of 2023 onwards. Second, another hit piece, Free Fire, was banned in India, which so happens to be one of the biggest and most profitable market. So the reason for the ban currently is unknown, but the word on the street is that India is taking decisive actions against China. And despite Sea Limited being a Singapore company, the founder, Forrest Li, was born in China, who subsequently moved to Singapore. On a brighter note, however, the ban was instituted back in Feb of 2022, and we've seen Garena's numbers deteriorate for more than a year now. And it does seem like quarterly active users have kind of bottomed out in Q4 of 2022. So it will probably be prudent to do any subsequent projections or even modeling on this new base figure provided by Garena. So you know what else is being prudent? Gently tapping on the like button, of course, and hitting onto the subscribe as well. Make sure to catch our latest stock analysis, which we think would be a smart decision. So the second reason for this revaluation was the rising interest rate environment, which was particularly harsh to growth stocks, and coupled with the hit on their gaming business, Sea Limited was left in a rather tight spot. So as their gaming business was the only profitable business arm of the company, they were essentially using Garena's profits, subsidizing the growth expenditure for both Shopee and Sea Money. So without this so-called quote-unquote subsidies from Garena, Sea Limited's bottom line would be plain out disgusting, losing more than $2 billion freaking US dollars per year in 2021 and 2022. So coupled with the fact that the US Federal Reserve has been raising rates at an unprecedented rate, many high-growth, unprofitable companies were at the mercy of Papa Jerome Powell as the environment to raise capital and grow becomes exponentially harder. So back then, investors were even casting aspersions on whether Sea Limited was running the risk of going bankrupt at the rate at which they were burning cash. So the third reason was just the overly optimistic projection of Sea's growth moving forward. So at its peak, Sea Limited was trading at more than 30 times price to sales. This is sales, by the way. There were no profits or earnings to begin with. So many investors are probably expecting Sea Limited to be able to deliver on the stellar growth rates that they've done in the past. Hence, many investors were willing to pay a premium for it. But after this drawdown, we kind of know that there is still a price too high to pay. So given the macroeconomic context Sea Limited was in, they had to pursue a different strategy moving forward. So since ship capital was no longer readily available, they do have a limited time to quickly cut back on expenses and to focus on profitability instead, as they were hanging on a thin thread with their balance sheet capacity. So in the latest quarter, the management team over at Sea has wowed investors again with their focus and also execution. So within a few short months, all three business segments have turned EBITDA profitable. However, investors did not seem to like it at all because it came at the expense of the overall growth of the company. So on the aggregate, they have managed to only grow 5% top-line revenue, with e-commerce at 20.6%, gaming at negative 41% year-on-year, and finance at 53%. On a brighter note, Sea's cash balance has started trending upwards again, suggesting that they will not be in a precarious position to urgently raise money to sustain their operations. We have also seen some commentaries stating that Sea Limited used to be burning cash, and now that they've proven themselves to investors that they can turn profitable, the market still chose to punish them by selling down their stock. So we think that it is more meaningful to look at the entire picture. So Sea Limited's story was really predicated on being the dominating force of both e-commerce and gaming in the Asia, and more specifically the Southeast Asia region, especially with the huge total addressable market and long runway ahead. So although they've turned EBITDA profitable, it was at the expense of growth. And the story of Sea being able to capture a large part of this TAM is under scrutiny now. So layer that on with the difference in investor psychology. Early SE investors are most probably growth investors. So if you put yourself in their shoes, would they still put their capital in a company that is only growing the top line at 5% year-on-year when there are many more other candidates out there which poses much higher growth rate? We doubt so. It does seem like there is a change in the shareholder structure from one of growth to one of value. And right now, the value of Sea Limited today is contingent on how you evaluate the team on managing this current inflection point. So for investors interested in knowing what are my worries with Sea today, do head over to our blog at piranhaprofits.com, where I've outlined two specific issues that I'm concerned about. So the link to the article will be in the description below. So we know that many investors would be wondering if it is a good time to buy Sea Limited stock right now. And that's where we go into their current valuations. Sea Limited is in a fairly interesting position. Their recent strategy maneuver was essentially due to the macro conditions, pivoting from growth to profitability. But it left a sour taste in many investors' mouths because that was not what they've signed up for. So Sea's management has proven to shareholders that they're able to deliver bottom line profits when staying afloat is called into question. However, the current atmosphere amongst investors is that many of them believe now is not the right time to focus on profitability. There is still so much more room for Sea to grow into, while at the same time, opportunities to expand the moat around the company. So at least in our assessment, we do deem Sea as having a relatively narrow moat, which might suggest that they will have a hard time competing from here on. Although, we must give credit where it is due, they might very well come on top as they have shown us in the last few years, beating rivals like Lazada, which has the backing of Alibaba Group. So backing Sea Limited today is basically betting that they are able to re-accelerate the growth in both the e-commerce and digital finance business. So I would argue that even though we are seeing signs of bottoming and even some sort of consolidation for the gaming business, I am not placing much emphasis and even expectations on them to accrue any meaningful shareholder interest on the bottom line. So Garena's job now is just to soften the blow of Sea's expansion strategy. So given that the management at Sea has signaled to investors that they are going to be accelerating investments to growth again, we can probably expect that their bottom line to take a hit again sometime soon. For 2023 at least, I believe that they are going to keep to their word on delivering profitability, to at least show to investors that they can. So assuming that they are able to continue maintaining this level of profitability, they are currently doing around 500 million in adjusted EBITDA per quarter. That means that Sea Limited is trading at around 11 to 14 times EBITDA. So it is definitely not an expensive valuation to pay specifically for a growth company, but it is purely contingent on whether Sea Limited is able to deliver growth again. So we would reckon that Sea Limited is not a company with a wide economic moat yet. Investors would probably classify Sea as a speculative bet on a portfolio level. So given how the management team has described their game plan, you have to be ready when Sea Limited swings back to being highly unprofitable again. So the determining factor would then rest on whether Sea is able to build their moat with high quality growth that is accrual to the business in the long run. So this is CK from Piranha Profits signing off. Keep winning.